Hi, I'm Christine Benz from Morningstar.com. It's Tax Relief Week on Morningstar.com. Joining me to discuss some of Morningstar's favorite municipal bond funds is senior analyst Beth Foos. Beth, thank you so much for being here.
Thanks for having me.
Before we get into some of the specific funds that you and the team like, I'd like to talk about the case for holding municipal bonds inside of a taxable account. What are the tax advantages of doing that?
Sure. Well, muni bonds are most attractive for folks that are looking to manage the tax consequences of their investments, primarily because the interest earned on muni bonds is generally free from federal income taxes. And depending on where that investor lives, they can also be free from state income taxes and local income taxes as well.
Okay, so if I live in California and I'm buying California bonds, I may get I will get the national tax break, and then I may also get the state and local tax break too.
Absolutely.
Okay, so let's get into performance of munis before we get into the specific funds that you want to talk about. Performance has been really good.
Sure.
When I look across year to date through mid-February or the 1 year trailing returns, every single muni category is in the black. So what has been driving that? That's better than is the case for the taxable bond categories, where you have various categories that have sunk.
Absolutely. Munis actually fared relatively well through the rocky markets of 2015, and that has also played true in 2016 as well. I think it was actually one of the top performing fixed income asset classes for 2015 and is doing, again, as you said, very well in 2016. And I think that's primarily because we've seen some of the larger issues that were weighing down the taxable bond and equity issuers, such as the decline in oil prices or the general concern over slower economic growth, primarily in emerging markets, they just don't impact muni issuers as directly or as significantly or immediately as they do some of those other issuers. So we saw a lot of that market volatility in the corporate bond and equity space cause some flight to quality for investors, especially in the second half of 2015. And munis have always been regarded as a higher quality, lower volatility sector. So we saw a lot of inflows into muni funds. At the same time, issuance was kind of flat or lower than historic levels. So
how does issuance help munis' performance? Low issuance specifically.
Low issuance specifically,
yeah.
Sure. Well, when you see a high demand and you don't see a lot of new issuance, obviously the bonds that are currently out there are going to have
prices.
Higher price point, yeah.
Okay. So it's interesting, though, even though maybe municipal finances haven't been on the front burner, these other things have been concerning the market.
Sure.
Municipal finances troubles haven't gone away. We live in Chicago, Illinois, where certainly there are plenty of issues. So let's talk about that and talk about kind of the state of municipal finances and how investors are thinking about that today.
Sure. I think we have seen and will continue to see some very stressed situations grab the headlines over 2015, and that's going to continue into 2016. As you mentioned, the city of Chicago has quite a significant budget struggle. The state of Illinois, we're seeing, the Commonwealth of Puerto Rico declare that it can't pay all of its obligations. So those things are they're stressed, and they'll continue to weigh on potentially some of the funds that they currently reside in. But overall, the credit quality of the muni market continues to grow. It's strong. Defaults remain very low. So overall, I think we're continuing a very strong trend.
Okay. Let's talk about what you and the team look at when you are evaluating various firms and the quality of their municipal bond fund lineups.
Sure.
What are some of the key things that you home in on?
Well, because the muni market is so large, it's in diverse and quite fragmented, we want to make sure that we look for funds that have very strong, robust research capabilities. We look for teams that have experienced managers, a robust credit and quant staff, and then pretty sophisticated tools that support them, that can help them analyze the certain either credit or interest rate risks that they take on in their portfolios.
And expenses, of course, are a factor.
Of course, expenses are always a factor in that.
So you brought some of the team's favorite funds, and you kind of segmented them by type. So let's start with, say, a short-term, high-quality muni fund that you like for the person who maybe has money that they expect to spend within, say, the next 5 years.
Sure.
What's a good option for someone like that?
Sure. Well, you know what? I'll back up and say that the funds that generally check all of the boxes that we're looking for, and particularly in the muni space, those firms are Fidelity and T. Rowe Price. We really like their muni teams. We like their muni offerings, specifically the national muni offerings. They're because they have invested in their teams, invested in their tools. They offer pretty consistent returns at a usually a lower price point. Vanguard, also obviously known for its very low fees, has a pretty straightforward strategy when it looks at munis as well. So, but specifically for those with interested in a little less interest rate risk, Fidelity's gold-rated limited-term muni income fund is something to take a look at. T. Rowe's tax-free short intermediate fund, or their Summit Muni intermediate fund, is also a really good choice.
Okay. And how about for an investor who has a slightly longer time horizon?
Again, I would look towards the gold-rated funds. T. Rowe Price tax-free income and Fidelity's tax-free bond funds are very good choices because, over the longer term, they're providing very consistent results with lower volatility and lower fees.
Okay. It's interesting, within the muni space, a lot of the issuance is long maturity, correct? And a lot of the funds are set up to focus on the long maturity bonds. So let's talk about a fund or two that you like in that area, because that is where a lot of the assets are.
For the longer maturity bonds. We really like the T. Rowe Price tax-free bond. Again, it consistently takes a limited amount of credit risk. It really manages that, and its interest rate risk. But at the same time, again, offers lower fees and not a tremendous amount of volatility, which I think people are really looking for in their longer muni portfolios.
I'd like to talk a little bit about high-yield munis. It's been interesting to see that even as high-yield taxable bonds have had a rough go of it recently, high-yield munis have been doing okay. Why is that?
Sure. Well, again, I think it's because some of the salient issues that have affected the high-yield corporate bond issuers, equity issuers, just aren't the same as we see in the high-yield muni market. They're not affecting the issuers in a similar manner. So the steep drop in oil prices again, or the concern over slower growth and the emerging market sector really don't directly impact some of the muni sectors that we traditionally see in the high yield space, such as tobacco or some of the lower credit quality hospital sectors, for instance.
Which is why they performed relatively well.
Yep.
So you've got a fund that you like in this area, but
Sure.
Let's talk about in addition to that fund, let's talk about the role that a high-yield muni could serve in a portfolio. Should you think about it as kind of the aggressive kicker when you've got your core high-quality piece built out?
Well, the specific fund that we do like in the high yield space is T. Rowe Price's tax-free high yield fund. We give that a gold rating, and again, I think because it takes a certain amount of calculated risk, and it delivers consistent results, especially in down markets. But I think how people should look at that high yield fund, that role in their portfolio, you're going to get a little bit more yield there. So if that's what you're looking for, that's good. But in the same sense, we still have to take a bit of caution with that because, again, there's risk associated with those higher yields. And we want to make sure that the manager and the investor can know what those calculated risks are and how to manage that.
Okay, Beth, thank you so much for being here to share your insights as part of our Tax Relief Week.
Sure. Thanks for having me.
Thanks for watching. I'm Christine Benz from Morningstar.com.